Question 1. A blockchain network uses a BFT-style consensus mechanism. Which scenario best describes how a new block is accepted? A. Validators race to solve a cryptographic puzzle, with the first solution accepted. B. A majority of validators, over 2/3, vote on a proposed block before adding it. C. Nodes stake tokens, and one is randomly selected to propose the block. D. All nodes must solve puzzles, and the slowest solution is chosen. Answer B. A majority of validators, over 2/3, vote on a proposed block. Explanation. BFT, Byzantine fault tolerance protocols typically require two of validators to agree on a block for finality, not race-style proof of work, not random PoS selection. This ensures tolerance to up to 1/3 malicious nodes. Question 2. In the context of AMMs, automated market makers, why does providing liquidity to a pool with very imbalanced assets risk you suffering from impermanent loss? A. Because large price shifts cause your deposited token ratio to diverge from holding. B. Because arbitrage bots charge liquidity providers extra fees. C. Because decentralized exchanges enforce penalties on imbalanced pools. D. Because trading volume decreases in imbalanced pools. Answer A. Because large price shifts cause your deposited token ratio to diverge from holding. Explanation. With constant product AMMs, when price shifts occur, your shares token balance rebalances, potentially reducing value compared to just holding the tokens. Impermanent loss arises when prices move significantly. Question 3. Mr. Patel deposits ETH as collateral on a lending protocol, borrows a stablecoin, and price of ETH drops suddenly. What should he monitor first to avoid liquidation? A. The total TVL of the protocol. B. His collateralization ratio and margin call threshold. C. The protocol's tokenomics model. D. The trading volume of ETH on centralized exchanges. Answer B. His collateralization ratio and margin call threshold. Explanation. In DeFi lending, liquidation occurs when collateral ratio falls below protocol's threshold. Monitoring ratios lets you top up collateral or repay before liquidation slippage. Question 4. Which analysis of an ERC20 token white paper indicates a potential security token rather than a utility token? A. Describes staking to access platform features. B. Offers revenue-sharing dividends to token holders. C. Details gas fees and token minting rules. D. Focuses on governance voting without profit entitlements. Answer B. Offers revenue-sharing dividends to token holders. Explanation. Revenue sharing implies security characteristics. Tokens granting financial returns are likely classified as securities under Howey test and must comply with securities regulations. Question 5. Which on-chain metric best signal a change in accumulated profit and loss across investors? A. Active addresses count. B. MVRV ratio. C. Transaction volume in USD. D. Block size. Answer B. MVRV ratio. Explanation. MVRV, market value to realized value, compares current market cap to aggregate cost basis. Indicates when holders are profitable, unprofitable, useful for cycles and sentiment spotting. Question 6. Which candlestick pattern in TA suggests a potential trend reversal after a sustained downtrend? A. 3 white soldiers. B. Bearish engulfing. C. Morning star. D. Shooting star. Answer C. Morning star. Explanation. A morning star appears after a downtrend small candle, then bullish and suggests reversal. Other patterns refer to downtrends continuing or uptrend reversal. Question 7. Which transaction on an exchange would most likely signal impending selling pressure from whales? A. A large outflow from exchange to cold wallet. B. A large inflow from cold wallet into exchange. C. Frequent small buys causing spikes. D. Balanced inflows and outflows. Answer B. A large inflow from cold wallet into exchange. Explanation: whales moving funds onto exchanges suggests intent to sell. Monitoring inflows helps anticipate sell pressure. Outflows indicate holding intentions. Question 8. Ms. Garcia notices her staked ETH disappears from the validator queue on a POS chain after inactivity. What should she do to minimize penalties? A. Redelegate immediately to another user without unstaking. B. Submit a voluntary exit and withdraw funds after cooldown. C. Send more ETH to reactivate the validator. D. Ignore it. The network will revive the validator. Answer B. Submit a voluntary exit and withdraw funds after cooldown. Explanation: in POS, inactive validators accrue penalties. Voluntary exit lets staker withdraw after unbonding while avoiding further slashing. Redelegation doesn't fix inactivity. Ignoring worsens penalties. Question 9. How does a soft fork differ from a hard fork in blockchain governance? A. Soft forks require unanimous node upgrade to avoid chain split. B. Soft forks are backward compatible. Hard forks are not. C. Hard forks don't change protocol rules. Soft forks do. D. Only hard forks require validator voting steps. Answer B. Soft forks are backward compatible. Hard forks are not. Explanation: soft forks restrict rules allowing old nodes to recognize new blocks. Hard forks are backward compatible and require all nodes to upgrade, splitting chain if not unanimous. Question 10. Which risk is most unique to DeFi yield farming compared to centralized finance? A. Credit risk from borrowers. B. Counterparty risk with central intermediaries. C. Smart contract exploit risk. D. Regulatory compliance risk. Answer C. Smart contract exploit risk. Explanation: DeFi protocols rely on code and are subject to bugs and exploits, unlike CeFi, which relies on legal financial intermediaries. Other risks exist in both sectors. Question 11. Which option best defines the role of realized cap in on-chain analysis? A. Total market cap multiplied by velocity. B. Sum of the value of all coins at current price. C. Market cap accounting cost basis at time of last transfer. D. Circulating supply divided by realized value. Answer C. Market cap accounting cost basis at time of last transfer. Explanation: realized cap values each coin at price when last moved, reflecting actual investor cost basis, useful in profit loss and MVRV analytics. Question 12. When analyzing a token's order book, which insight suggests potential price manipulation? A. Plenty of small orders near market price. B. A large iceberg, limit order far from market. C. Balanced depth on both sides. D. No bid-ask spread. Answer B. A large iceberg, limit order far from market. Explanation: large hidden orders may signal spoofing or manipulation, removing big orders to influence perceived depth. Question 13. Dr. Lee holds multiple stablecoins, and the Terra USD peg breaks due to depegging events. What would be the best portfolio move? A. Move all stablecoins into USD to arbitrage potential rebound. B. Diversify into different stablecoins with varying collateral models. C. Convert all stablecoins into fiat off-chain to avoid on-chain risk. D. Use USD to farm yield aggressively. Answer B. Diversify into different stablecoins with varying collateral models. Explanation: Stablecoin risk differs by model. Algorithmic Vs collateralized. Spreading exposure reduces systemic failure risk. Converting to fiat works but may miss on-chain utility or introduce CeFi risk. Question 14. Which metric best helps infer developer activity and project health on GitHub? A. Number of stars. B. Total forks count. C. Recent commit frequency across repos. D. Issue views count. Answer C. Recent commit frequency across repos. Explanation. Active commits reflect actual development. Stars or forks indicate popularity but not ongoing work. Question 15. What does a sudden spike in funding rates on perpetual futures indicate? A. Strong bearish sentiment with more short demand. B. Strong bullish sentiment with more long demand. C. A balanced market. D. Reduced leverage usage. Answer B. Strong bullish sentiment with more long demand. Explanation. Positive funding means longs pay shorts, reflecting majority bearish view receiving fees, indicating exuberant long positioning. Question 16. Which technical indicator combination is most useful for confirming trend strength and potential reversal? A. RSI crossing midline and price breaking EMA. B. Volume declining while price rises. C. Bollinger Bands contracting. D. MACD histogram still trending upward while price falls. Answer A. RSI crossing midline and price breaking EMA. Explanation. RSI above 50 confirms momentum. A price break above EMA supports trend continuation. Others may suggest confusion or volatility, not clear confirmation. Question 17. In proof-of-work networks, why is hash rate correlation with network security so critical? A. Higher hash rate reduces mining reward per block. B. It increases resistance to 51% attack. C. It slows transaction confirmations. D. It decreases block size. Answer B. It increases resistance to 51% attack. Explanation. High hash rate means high cost to obtain 50% of network hash power, thus improving security. Question 18. Why are stablecoins like USDC generally considered lower risk than algorithmic stablecoins? A. Backed by collateral reserves audited regularly. B. Peg maintained by arbitrage bots. C. Their code is always flawless. D. They trade exclusively on centralized platforms. Answer A. Backed by collateral reserves audited regularly. Explanation. USDC is backed by regulated assets with transparency. Algorithmic coins rely on smart contract stability and market confidence, more fragile. Question 19. Which macroeconomic event is most likely to cause a sharp increase in cryptocurrency volatility? A. A minor change in interest rate forecasts. B. Annual CPI release significantly deviating from expectations. C. A routine monetary policy meeting with no new guidance. D. Public holiday trading session. Answer B. Annual CPI release significantly deviating from expectations. Explanation. Surprising inflation data often triggers risk on-off moves, affecting crypto due to its perceived risk-asset correlation with macro data. Question 20. Why do decentralized exchanges like Uniswap require twice the amount of each asset for a liquidity pool deposit? A. To enforce equivalent value ratio for pricing. B. To discourage large liquidity providers. C. To charge higher fees. D. To offset smart contract insurance costs. Answer A. To enforce equivalent value ratio for pricing. Explanation. AMMs require equal value deposits to maintain constant product formula, ensures correct pricing and pool stability. Question 21. Which legal obligation applies when a crypto analyst in the EU advises clients on token investments? A. Must only comply with U.S. SEC rules. B. Must ignore KYC AML laws. C. Must follow MiCA regulations, including potential licensing requirements. D. No compliance required when working remotely. Answer C. Must follow MiCA regulations, including potential licensing requirements. Explanation: MiCA markets in crypto assets, sets EU regulatory framework requiring registration, compliance with investor protection, and AML obligations for analysts. Question 22. Mr. Alvarez, an analyst, spots a token that promises daily fixed returns of 2%. What should he conclude based on concept understanding? A. It's likely a lending protocol, safe. B. It's likely a Ponzi or unsustainable high-yield scheme, avoid. C. It's automatically a security token due to yield. D. All DeFi yields are guaranteed and fine. Answer B. It's likely a Ponzi or unsustainable high-yield scheme, avoid. Explanation: unrealistic fixed high yields often indicate Ponzi dynamics or rug pulls. Analysts must flag unsustainable promises, protecting investors from fraud or collapse. Question 23. What distinguishes Solidity smart contract logic for creator royalties in NFTs? A. It sets a royalty percentage in the contract that automatically pays creators on secondary sales. B. It uses off-chain agreements recorded in metadata. C. It relies on marketplace honor code. D. It prevents any transfers after mint. Answer A. It sets a royalty percentage in the contract that automatically pays creators on secondary sales. Explanation: ERC 2981 and marketplace standards enforce on-chain royalty logic, not enforced via off-chain documents or honor systems. Question 24. What does tracking a coin's realized profit loss help you understand? A. Only current holders when they bought in. B. Whether the average investor is currently in profit or loss. C. Trading volume over 24H. D. Total outstanding supply. Answer B. Whether the average investor is currently in profit or loss. Explanation: realized PL aggregates gains/losses based on cost basis of coins moved, showing collective holder profitability. Question 25. Which portfolio metric accounts for downside volatility when measuring risk-adjusted performance? A. Sharpe ratio. B. Sortino ratio. C. Comma ratio. D. Alpha. Answer B. Sortino ratio. Explanation: Sortino focuses on downside deviation only, making it more relevant for asset classes with asymmetric risk like crypto. Sharpe uses total volatility. Question 26. In options trading, what does a straddle strategy involve and reveal? A. Buying call and put with same strike, anticipating large volatility. B. Selling only calls to earn premiums in sideways market. C. Buying both calls at different strikes, expecting mild move. D. Selling put and buying call at different expiries. Answer A. Buying call and put with same strike, anticipating large volatility. Explanation: a straddle profits if price moves significantly in either direction, useful for volatility plays. Question 27. Which factor discriminates a truly decentralized blockchain from a semi-centralized one? A. Number of nodes. B. Who controls the majority of validating power. C. Block size limit. D. Whether it runs a white paper. Answer B. Who controls the majority of validating power. Explanation: decentralization is defined by control distribution. If a few entities validate most blocks, it's less decentralized regardless of node count. Question 28. which sentiment indicator might signal short-term bearishness despite rising price. A. Fear and greed index and greed. B. Spike in network active addresses. C. Negative divergence between price and MACD histogram. D. Increase in stablecoin inflows to exchanges. Answer D. Increase in stablecoin inflows to exchanges. Explanation: more stablecoin on exchanges may indicate impending sell pressure. MACD divergence more technical trend signal, not sentiment. Question 29. Why is cross-chain interoperability using protocols like Cosmos important for blockchain ecosystems? A. It lets users stake once and earn on all chains. B. It allows asset transfers and composability across chains without centralized bridges. C. It forces governance unification. D. It mandates using the same consensus across zones. Answer B. It allows asset transfers and composability across chains without centralized bridges. Explanation: interoperability enables communication and value transfer across heterogeneous blockchains securely and without trusting centralized intermediaries. Question 30. How does tracking exit scam patterns in DeFi help analysts evaluate risk? A. Identifies false marketing hype. B. Detects weird wallet activity, sudden liquidity removal, high dev transfers, signs of rug pulls. C. Indicates healthy protocol tokenomics. D. Measures user growth. Answer B. Detects weird wallet activity, sudden liquidity removal, high dev transfers, signs of rug pulls. Explanation: red flags include dev wallets draining funds, devs renouncing contracts, or abrupt TVL exits, critical signals to protect investors from fraud.